What's up, everybody? Michael Silva here. You're watching the Daily Stock Market Brief. Today's Thursday, February 18th. Today we got a lot to talk about. The structure of today's video is going to be a little bit different than usual. I'm going to walk you through charts and kind of my thought process. Right now, what I'm trying to tell everybody is, once again, we need to be patient in these times. We need to be very careful in these times because a lot of bearish things are lining up, but yet we're in really bullish context. Okay, what does that mean to, anybody? Well, it means that if you're having a confusing time getting in and out of positions or finding good setups, well, you should be having a hard time because of how the market has been acting. Okay, we're going to look at some large context charts, and then we're going to also zoom in a little bit. So let's just go ahead and get into today's show. Hey, what's up? Welcome back. It's me again. It's Mike. We're looking at the monthly time frame for the BKX. What's the BKX? This is the banking index. We're looking at like the largest 24 institutions on the monthly time frame here in the United States. The KBW Bank Index. This is very important to the equity markets, all right? A long time ago, I posted this chart, but we looked at this left shoulder head, and then this looked almost like it was forming another shoulder, which could have broke down through that, and that would have been pretty devastating, I tell you, to see the financials crack through that neckline. But clearly, what happened? Well, plow right through the freaking roof, right? We're starting to see yields move up, and guess who benefits from higher yields, higher long-term yields, right? The 10 and the 30. Well, banks do. Why? Well, because they take in customer deposits, right? Short-term borrowing, and they, don't reward us with saving money. And then they lend long-term, and rates are relatively low still. But the more that they go up, the higher margin that they can make on, home loans, for example, or car loans, or any high-ticket items. Why am I showing you this chart? Well, first off, it's up 13.83% in the month. All right, and just since 2020, when we came down this low, it's up, over 100% from the low. So just absolutely astonishing move. However, this red resistance up here, I'm marking out as that all-time high, and you can definitely see that there'll be a negative divergence building right here because it was high here, it's a lower high here, and clearly it was very overbought at this time. But notice every time it comes up into this quote-unquote red zone, something happens in the markets. Not to say that something will happen this time around, but we need to be careful that we're seeing this rubber band type move into an area of resistance, and clearly it's been resistance once, twice, 3 times here. And notice it can hold up there for multiple months at a time as well. But look at right here. This was in 2007, 2008, right? We came into it, plow, flopped right down, okay? When we worked ourselves all the way back, years and years of zero interest rates. And then we started to raise rates again, and I think it was late 2015 or late 2016. I don't have it in front of me. Rates started going up a little bit, okay? And then everything was fine, but then plow. What happened in 2018? We had all that repo stuff going on, right? Bam, fell to the downside. Then we started to recover up. Everything's going good. And guess what happened? We got up here, and then the pandemic hit. All right, and then unlimited QE and rates back down to zero. Plow, this is flying through the roof. All right, not to say that this can't break this, and this could become a solid area of support. All right, so this could be bullish. We do see the MACD, that crossover here, bullish crossover. It's heading above zero. It's not fully there yet, not both the lines, but it's heading there right now. Will this resistance be broken? Perhaps, but we got to wait and see. What I want to call out, though, is it's still resistance. All right, and if we fail to get above resistance, it could be rejected where we head down lower, which we've seen. How low? I don't know. We'd have to come back and check at it. But just know that, if the banks are going to be running into an area of resistance and then all of a sudden we see them struggle, it could put pressure on the equity markets. And I cannot get over this chart. I can't get over how similar the price action is on the S&P 500. All right. So I showed this out on Twitter. If you don't follow me there, you can follow me there. But everything, I want everyone to just jump back into, late 2019 into 2020. Okay. I remember just trading and looking at the market during this entire time, and everything which just kept on grinding higher and higher with no real consolidation. It's literally the same thing. And you can see that with the price action that I have highlighted in both boxes. All right. And then out of nowhere, and everyone says, oh, this is because of the pandemic. And yeah, we had the pandemic and it went down. But what we need to call out for is, one, we're still in it. All right. It's still here. Yes, there's good news coming out, But you got to understand how we recovered so quickly is not good for the economy. Just flooding us with cash and unlimited quantitative easing is never a good thing. It just goes to show you if it can have good consequences, well then it can also have bad consequences, and you need to be aware of that. All right, so what's crazy to me is just the price action. That's what I wanted to point out, right? So we had this kind of just going into 2020, just early 2020, January, we saw the markets had a great start to the year. Then we saw a little bit of a pullback. It recouped, basically came right back to where it opened up. All right, so it came all the way back, and then it recovered right there. And just look at the moving averages. Okay, it came down to the 50 period, recovered and bounced up, broke through the prior resistance to an all-time high. Right here, we bounced down to the 50 period. I've said this before. We recovered, and now we're coming right back down to this area of support, right? So this was the little hammer candle right here, where we have a hammer candle right here. And I post on top, I'm like, I swear, if we get a gap down tomorrow and we finish a solid red day into this green line, basically the 20 period moving average, I like there's somebody messing with us, because that's just absolutely insane, all right? The market is acting just how it did right before the mayhem kind of took place. Now, do I think that it's going to be the same outcome? I personally do not think that it will. However, what I will say is the market, the way that it's been moving and the way that it's been extended and these continuous grinds higher and higher, it has been set up. It's set up for a move just like this. It's set up for a move to, 3,600, 3,500, or even come back, 3,550, this kind of zone in here. The market's set up for that. We need to be prepared for if it does. All right, so if we do get a pullback, or if we get all of a sudden a gap down through the 50 period moving average and some increased selling and some more fears, we need to be ready to start buying at specific levels. And we'll talk about that in future episodes. As of right now, we're still in bullish context, okay? So that's what you got to pay attention to. We are in very bullish context right now. You have the 20 above the 50 above the 200, just like we were here, 20 above the 50 above the 200, all sloping up. Okay, so everything looks fine from a bullish perspective. So you got to understand, you got to play it how it is. And right now, it's not something that you'd really want to short. Okay, you'd get lucky if this happened if you were short, but you can't. It's not a game of luck. You need to make sure that you're doing this and trading properly and managing risk properly. If you're shorting by just hedging and you have some hedge shorts, but you're also going to be buying long, then that's a whole different story. But if you're just a one-way sided trade short into the market, yeah, I hope you get lucky, but just know that that has not worked. All right, it hasn't been working too well. Intraday shorts are completely different. So this looks just absolutely bonkers to me, just how similar it is. This also looks very bonkers to me of how similar it is. All right, so same time frames, right? 2020, 2021 right here, the beginning of the year, a little bit into the previous year. You can see the negative divergence. This is a breadth indicator, negative divergence, right? We pulled down to this minus 60 level. That was when we hit the 50 period moving average. You see right here, boom, boom. So that negative 60 breadth happened right here and right here, okay? Interesting, all right? And then we came back up, got some positive breath. Cool, everything looks fine, made all-time highs, and then we started seeing negative breath, and now we're starting to see, or saw negative breath here, and now we're starting to see some negative breath here. All right, this does not mean that the same thing is going to play out. Once again, all right, I'm just calling it as I see it, and how as I see it, it's literally a mirror image to me. It's pretty crazy. And then you mix in the VIX to that. Well, I mean, look at where we are on the VIX. We're darn near where the February crash, March crash started to take place. All right. We're at the lower range. We still haven't filled this gap down here. So we've still been making new highs in the market at a pretty high level in the VIX, relatively speaking. All right, today we saw a little bit of an up day, but you can see it went up higher and it got stuck up at that 20 period moving average, right at some previous resistance, and then it came back to close lower. This is a shooting star type candle. So maybe, being that it's OPEX week tomorrow, maybe we get a VIX crush and the market pushes higher. Maybe it doesn't. If this market wants to do exactly what it did last year, then we wouldn't really see the market go up tomorrow. But you never know. You just don't know. I'm just calling it as I see it. It's pretty crazy. This resistance is holding, shooting star type candle. Maybe it moves down lower. That pushes the market up higher. I'd like to see this gap closed. I'd like to see it filled eventually, but so far, it's been just a long time since it even really got close, and now we're, we almost got there again, but we're not there. Next thing I want to show you. All right, this is the lumber to gold ratio, the 13-week range, right? So 13-week rate of change is what we look at when it goes below zero. That means that the conditions for a market, not crash, but a market, more volatility come into play are increased. So right now it's a risk-on trade. And by the way, this could lag a little bit. It can get there a little bit earlier, so we can look at different time frames, which I'll show you. But just know, lumber had a pretty big down day today, but it's been riding just super, super high. Lumber's been outperforming gold, and now we saw a pretty big down day in lumber. Maybe it's just taking a breath before it heads even higher, but you got to understand, like, if lumber prices continue to go higher, there comes a point when we talk about supply and demand, what cures high prices? High prices cure high prices. So if it's a supply issue, well, if the price gets super high, the supply issue is going to get fixed because the demand's going to go away. Not completely. There'll always be a demand, but you got to understand, like, you go into Home Depot and a 2x4 costs $8. How can you build, with lumber being so expensive, and you're starting to see, home prices rise like crazy. Obviously, you saw that last year. It was like up 14% in certain markets in a year. It's mind-boggling. Okay, so this is heading down. Okay, this is like that little double top here. We're heading down the rate of change. If we get below zero, that means the following week we have to be in a risk-off type environment. Which what does that mean? Well, you can be in various assets like utilities, cash, bonds, stuff that is less riskier, stuff that people move out of instead of just high risk, high beta equities. All right. Now, what's crazier too is look at the 3-week rate of change. The 3-week rate of change was up here in February beginning, and then bam, we are almost at zero, almost below zero. Maybe we get there tomorrow, maybe we don't. I don't know. But that means on the shorter time frame for this, it means we could be risk off a lot sooner. And that would make sense. If this continues to head down, we'd be risk off. Now, the 3-week rate of change, the thing about this one is that you got to trade more frequently on it. So it can be wrong more often, but it can also be right early. All right, so look at this right here. It was going up and down, trading around this 2020, but as soon as it made this decisive move down through the zero line, this is right when that March crash took place, all right? So right here it crossed down, and you can see that pull back a little bit steeper. Here it crossed, and then we didn't really go down, but you can see this moment of, just kind of chop back sideways. So it works. The 3-week rate of change works. It just, you need to be a little bit more quicker, and you'd have to trade more frequently based off of it. Then we have the rate of change on utilities over SPY. This is part of Michael Guyad's beta rotation strategy. What I want to call out here is we've been kind of floating around this zero marker, not quite getting above it fully. And you can see there in late 2019 to early 2020, we were doing the same thing, kind of ping-ponging back and forth from risk on to risk off. And you can see that the relative strength went sideways and a little choppy. We see that here, very choppy, a little bit down through this box there. And we're seeing it go down a little bit here, but now we're starting to see an uptick, right? Utilities performed well today. Not to say that that's going to be the continuation of strength where we see, but we need to call it as we see it right now. And as the day progressed, we saw utilities outperform the market, the SPY overall. Okay, and then we start looking at things like the IWM, the blue channel that it's in. All right, we're at a very interesting point right here. We had the price percent oscillator, bearish crossover, still above zero, spreading out, pointing down, and we're at the bottom range of this channel. Does this now get bought up because we're at the 20-period moving average? Everything based on a technical perspective would say that this is actually a good buying opportunity because we're pulling down into a level of resistance, and that was previous resistance, and now it's support, and it's in bullish context. Okay, so we weren't buying up here. 230 came down to 220, down 1.5% on the day. This to me is telling, it shows that it could be a great opportunity to buy. Why am I hesitant right now? Well, it's because, the price percent oscillator just had a bearish crossover, and a lot of other things are looking, a little sketchy. As far as the risk on, risk off indicators go, where the VIX is located. But if you are to buy long right here, you'd want to have a stop loss below this gap or below the 20 period moving average. And then when you even zoom out further and look at a weekly time frame, just look how nasty this candle is right here. Very bearish looking. This gap up for the week, and then we're way down here below the previous week's open and even where the week prior to that closed. So it's a very bearish looking candle. It's in bullish context, all right, but we're far disconnected from the 13-week moving EMA. And it's in the structurally speaking, it hasn't taken a breath, since October of last year. It's just been straight up, all right? And it's a big rising wedge pattern. You have the negative divergence here. It's still overbought. So a reconnect to 205, potentially even lower, or the bottom range of this channel of this rising wedge would make sense. All right, this is why I'd say I'm just not like extremely bullish. However, when you look at the daily, like I said, yeah, maybe you catch a little bit more moves to the upside here. Okay, it's very, very hard to play these conditions because the fact is we have bullish context, but we have some structurally unsound things going on as far as patterns perspective. You look at the Qs, all right, we gapped down today into the 20. That's where we found support. We moved back up into the open of yesterday. All right, so this is a pretty solid looking candle, but we finished down on the day. The 20 period has been acting as support. The price percent oscillator looks like it wants to start crossing over, but it's still relatively flat. Overall context is still bullish. So it's, like I said, it's just very, very hard price action to play. We've been getting gap ups, and typically when you get a gap up, you want to see momentum carry. And then when you get a gap down, you want to see momentum carry that direction. But what we've been doing is getting these gap downs and move up. Gap down and then move up. So it's like the futures market, what it was doing prior to all of this, it was gapping up and then the cash market was buying into it. Gapping up, buying into it. Now what we're starting to see is the futures market gapping down and the cash market still buying into it. All right, so what's the futures market doing? Maybe it's not doing anything. Maybe they're just taking some profits off the table before another just crack up to the upside. It's very very hard to determine. And if you're feeling like you can't get a trade right, well, just look at the context of things right now. Or if you feel like you're very euphoric and all you're doing is getting trades right, well, look at the context right now. The market's just been going up, all right? So you got to check yourself. Check the ego at the door. Look at both perspectives. Here's the Dow Jones on the daily time frame. I mean, look at, we've just been coming back to this 31,250 here, just nonstop. So as soon as we broke that level, it's been like boom, back test, boom, back test, boom, back test, float around, boom, back test, boom, back test. So it hasn't gone anywhere for multiple trading days. This entire week over here really hasn't gone anywhere, all right? And then it's just another important place to look at is where 2021 opened, right around here. So it's still up on the year, all right? And then it's in bullish context still. All right, this could be consolidation, but it's just very choppy consolidation at this particular point in time. Okay, so bullish context, support is holding. So these are all good signs. You can see this price percent oscillator kind of curling itself over a little bit. But once again, there's no decisive move. So as I record these videos for the last 1, 2, 3, 4, 5, 6 trading days, what have we been saying? Well, we've been saying that you have to be patient. You have to be careful. Is it consolidating? Is it going to pull back? It's very hard to tell during these times. And it should be hard to tell, especially with what we're seeing happen in the overnight sessions. On a weekly time frame, you look at the Dow Jones, resistance is holding. This could be drawn out a couple of ways, actually. So I could bring this line lower, which could suggest that this is breaking out, or you can draw it like this, where you're connecting this to this and then following through. It's still acting as resistance. You can see a very strong week here, and then the range of these weekly candles have been shrinking and getting smaller, which means that the momentum could be slowing for a period of consolidation or a pullback. That is typical to happen, or that's typical when you see these large moves and then all of a sudden the range of the candle gets smaller. The smaller the range, the less volatile it typically is. So you can see just these large ranges here. This large range shot us higher here, and as soon as they slow down, they get more consolidated. You see right here, and then boom, we saw to the upside. They slow down here, boom to the downside, boom, big one to the upside. All right, that's typical market behavior. The dollar is also very important to look at, so we're looking at it from a monthly perspective. Monthly perspective, since 2015, we've been consolidating sideways, really. I mean, that's what, that's what it is. So we went up, we went down, we went up, we went back down. And now we're coming into what this looked like was a bear flag. We broke through that. We came back to back test and broke back above. Here, look at how the month is performing. We broke down through the bear flag. We back tested it and we got rejected. And the price percent oscillator is below 0 on the monthly time frame and still heading lower here. However, when you look at the weekly time frame, you can see that this could be potentially the early stages of a breakout, retest, and then potential move, bounce higher. The RSI is a positive divergence. You can see a low here, a higher low there, where it was low here and a lower low here. And then you also see the price percent oscillator on the weekly time frame also trending up, but it is still quite below 0. I think the market, once it gets below, if the dollar can get above 92, it seems to me like if it does get there, it's going to be a decisive move like we saw right here in August of 2018. We know what happened with the markets during that time. Daily time frame for the dollar, it's been this mirror image, right? Lower moves to the downside, and then the S&P 500, higher lows to the upside. Then we saw a big move, but then that was followed through with weakness. With the dollar here, you can see this fake out little move right there, down slightly on the day, but it's still above this daily trading candle. And then what we said was if we see this continued strength to the upside, we can see the S&P pull back. But as you can see, we formed another hammer candle on the S&P 500, which could suggest that, that was just a temporary thing before we head higher. All right. And then energy sector, it's been doing really well, but what have we been saying? The market, it looks like it needs to take a period of consolidation, take a little breather, because the breakout was just so darn strong from this area. And now what do we see today? Well, let's see if this actually has some follow through. We gapped up and then fell down. This is a dark cloud coverage candlestick pattern. So if it has follow through below the lows of these and the high of this candle, which is right around $59, maybe just above that. If we can close decisively below that, that could send this into a period of consolidation or even a pullback. The RSI is very overbought right here. So it would make sense for it to take a little bit of a breather going into the following weeks. So let's wrap this up with a conclusion, okay? I want to bring back this chart just to kind of wrap everything up. So yes, the price action looks very similar to how it did last February. So from a seasonality perspective, things can repeat. I think that's way too easy, way too simple to mark. I just don't think it's going to happen. I think that the market set itself up now for even a stronger move to the upside. But you got to understand, what I think doesn't matter what the market does. All right. So just because I think something doesn't mean that I'm not prepared for if it goes the other way. And you need to think the same way, right? You might be so convinced on one specific stock. Oh, it's going to go up because of XYZ. And you create this narrative. Oh, it's not going to crash. It's going to go to 6,000 for the S&P 500 because of XYZ narrative. You got to just step away from the narrative, step away from ego, step away from individual talk tracks, because the market is going to be the deciding force. All right, what the market does is what the market's going to do. So if we see continued strength, you can buy into specific pullbacks. If we start seeing some really strong weakness, then guess what? You need to look for those areas that look like solid areas of support to buy into. And as I see it right now, everything is too mirror of an image of what it looked like in February before dramatic stuff started happening. And I know a lot of people say, well, this time is different because of this, and this time is different because of that. And, that was the pandemic. Duh, that's why it fell. Guess what? There's still the potential for a black swan event to happen again. All right, we see what's going on in Texas with the weather. We do not know what a black swan event can be, because they are what's the word that I'm looking for? There are events that take place when nobody is prepared for them. That's what a black swan is. Very few people are prepared, but the people that respond very quickly because they prepared themselves for it can make profits. All right. So just to give you an idea down here, some of my best trading was right here on this gap down. That gap down right there initiated some of the best day trading because of the volatility to the downside. So you can go back to my YouTube videos and watch my daily trading during this specific time frame. I think I had 30 days in a row of just solid green days catching moves to the downside. All right. And then when we got way down into this range, then I put out the video about buying gold and buying silver. And that was I was buying silver at $12 an ounce. Okay. That's incredible. I just, and it's just, I hold the physical and I bought some miners and so forth and caught huge moves to the upside. And this isn't to brag or say anything, but just understand that market shift. So you need a shift. If a market changes its mind, you need to change your mind. All right. So I'm rambling on and on, but you got to see what I see here. Okay. I see consolidation sideways. I see things hitting into main areas of resistance. So, I see the VIX still at relatively high levels, and I see that we're in OPEX week, which tells me that OPEX, we could still see the VIX go down tomorrow, but I got to be prepared for if there's something that happens in the last week of February to just have some sort of rug pull on us. All right. So once again, we're in bullish context, but we're running into some massive areas of resistance. We're seeing periods of consolidation. If you're having a hard time trading this, join the crowd. This is not easy time to be trading right now because there's a lot of euphoria, a lot of speculation, a lot of, just a lot of noise. There's a lot of noise. All right. So be careful out there. Hope this helps. Talk to you on the next Daily Stock Market Brief.